Hi there and welcome to the Stock Club podcast, coming to you from the top floor of my Wall Street HQ here in Dublin, Ireland. I'm James, and with me this week is my Wall Street co-founder and chief investor Emmett Savage and our head analyst Rory Carron. In this week's episode, we're talking about the impact of the coronavirus on the market, Bob Iger stepping down as CEO of Disney, and figuring out which companies will benefit from the growing legalization of gambling in the US. So guys, before we start off today's podcast, former New York Mayor Mike Bloomberg dropped out of the race for the Democratic presidential nomination this week. It's reported he spent at least $400 million on his campaign to date before dropping out. So I want to ask you guys, how many trips to space with Virgin Galactic could he have got for that amount of money?
Well, let's see. So we spent, so you're right, there's varying numbers.
410 million, I think.
410 million?
Least.
Okay.
I'll go with that one.
So at a price point at the moment to space, I think of $250,000.
Yeah.
So about 1,600 trips to space. Is that right?
Close.
Yeah, 1,700.
1624. I forgot you knew so much about Virgin Galactic. I was trying to.
I actually think I heard he spent 600 million.
Yeah, that's the number I heard. Actually,
yeah, 400 million was the kind of the low end of I think it was what he reported in January. In the filings they have to report, but I'd say it's probably a lot more than that.
Well, I'd heard 600 mil.
600 million is the GDP of American Samoa, which is the only primary he won.
Isn't it amazing?
So I assume he's going to move there now and be greeted like some sort of god king.
It's amazing to be able to throw 600 million at something to give it a shot
and not even care. Literally,
I'll give it a shot.
He found that down the back of his helicopter seat. It's.
And had he gone further, of course, I'm sure he had a war chest of. Maybe $1.5 billion?
He's got $60 billion in net worth. He could have literally just spent whatever amount and it wouldn't have made
You're talking real cash there.
What was that phrase? At some point it starts to make it's that you're actually talking about real money.
Exactly.
So moving on then to matters more related to the podcast. Last week was a particularly bad one for the market. Rocked by coronavirus fears, the market entered its fastest correction since the Great Depression, down more than 10% in just 6 consecutive days. Kind of digging more into that, the S&P 500 posted its biggest single day drop ever last Thursday, falling 4.4%, and overall an estimated $6 trillion was wiped off US indices last week. To put that into some context, US student debt figures are currently around 1.6 trillion, so a lot of money. Rory, I'll come to you first. So obviously the topic on everyone's mind is the coronavirus, so can we blame this massive sell-off specifically on the coronavirus?
I'm going to hit you with a bit of Latin.
Okay.
Right.
That's exactly what I wanted.
Just to raise the level of debate in this podcast, because I do think we've been letting our listeners down. Have you ever heard the phrase post hoc ergo propter hoc?
No.
It means, it translates, and I'm going to let myself down here, it translates something like after it, therefore because of it.
Okay.
So basically it's like just this thing happened after this thing, therefore it was caused by that thing.
So we've actually now launched a philosophy podcast.
Correlation does not imply causation.
Well, no, it's an informal fallacy that says just because something happened before something else does not mean it was the cause of it.
Yeah. Okay.
Yeah.
So I'll give you a little breakdown of something else, which is in April 2009, there was an outbreak of an influenza-like illness in Mexico, which spread to the United States quite rapidly. In June, the World Health Organization declared a global pandemic, which was the first time it had done so since 1968 with the Hong Kong flu. And in October, President Obama declared a national emergency. And by the time it had kind of leveled off, the H1N1, as it was called, had killed about 18,000 people.
Yeah.
What do you think happened to the market during that time?
It went up.
It went up.
It went up 40%.
Wow.
So, and obviously because what had happened beforehand was that America, or the stock market, had seen one of the biggest crashes in its history. So the market, people cared about H1N1, but the market didn't really care. They were more worried about getting, there was fears of the next Great Depression.
Yeah.
That was what people were worried about. So can you compare the two? Probably not, but it shows that the market is going to behave a certain way based on a number of factors. We've just had the longest bull run in history. The market was at all-time highs just a couple of weeks ago. And then suddenly there's a virus outbreak. It gives people a reason for the market to go down.
Yeah.
Doesn't necessarily mean it's what's caused it. And of course, look, coronavirus is going to have economic impact. Absolutely. There's no doubt the companies are going to have worse earnings over the next couple of quarters at least.
Yeah.
Maybe over the next couple of years. We don't know the extent of it.
Yeah.
But I don't think that the sell-off was purely based on the coronavirus.
Yeah, it could have been any excuse really, or any incident really that prompted this.
Yeah, like we were at a tipping point where literally any bad news could have caused a sell-off.
That's right.
This happens to be the bad news that has happened.
Yeah.
Look, none of us are doctors in here. We don't know how long this is going to be, and there's no point in asking anyone in here how long this is going to last or what the long-term effects are going to be. But I don't think that it's like, I think that the sell-off was probably going to happen anyway, regardless of a coronavirus happening. I think we were well due a pullback.
Yeah.
I mean, the fact that it happened so fast was worrying, but the market's just behaving very odd at the moment.
Yeah,
it is. It's the oddest I've observed, I'd say, in 12 or something years. And last Friday, I sat watching the stock market for, I think, about 12 hours nonstop, starting in Japan, moving to London, moving to US when it opened, and just trying to read what was actually happening money, because the news, the hysteria, whatever you want to call it, about coronavirus was out, and I was keen to see how the market would respond. And it's exactly that. It was just confused. Stocks were moving wildly up and below their opening price, plus and minus 5, 10, 12%. Yeah. There were stocks that just you'd see drop by 15%, up on business that close a business by 7%, and it just was bizarre.
I know there was I know we don't like to talk about points on the Dow, but there was like 1,000-point Dow swings in the middle of the day where at one point it was up 500 points and then it was down 500 points, and it's like you rarely see that.
Yeah, so rare. Yeah.
It's been a long time. I can't remember the last time where on the way into work I was actually checking the futures. I think it was back. Do you remember when there was a kind of Black Monday in China, maybe 4 or 5 years ago, and it was like everything was driven by China for a couple of weeks. Where if China was up, the American stock market will be up, and if it was down, the American stock market will be down. Whenever I used to come into work, I used to always check the futures. I haven't done it since then until kind of last week, where I was like, I wonder what's going to happen today, because it's so, you really don't know what's going to happen.
That's right. Yeah.
Well, speaking of kind of odd behaviour on the market, on Tuesday then of this week, the Fed delivered an emergency rate cut to try and soften, I think, the impact on the market of this panic, and it seemed to be the exact wrong thing to do. What were your thoughts on that, Rory?
First of all, like the fact that the market went down like 3% after a 50 points rate cut. I've never seen that before. It probably has happened, but I've never seen it before. But it just seemed like a really odd thing to do. Like, it's like, not being an economist, I'm not sure exactly how this works, but my understanding was you cut rates in order to free up cash to increase demand. Yeah. But we're not in a demand. This isn't a demand problem. It's a supply problem. Like, we're worried about supply from China, and we don't have the parts to make iPhones, so everyone's tearing their hair out. So I don't know. I don't know what the logic behind it was. It very much seemed like they're just cutting rates based on what the stock market does, which doesn't seem like a very good idea.
Yeah, I saw one tweet and was like, they're trying to distract the coronavirus with getting a mortgage out by cutting rates.
As someone said, you can't print vaccines.
Yeah, it just seemed like quite a heavy-handed approach to probably a very nuanced problem.
Yeah, look, again, not an economist, don't know don't know the ins and outs of it, but just seemed like a bizarre move to me, and the fact that the market reacted so negatively shows that maybe there's some distrust there now, or I remember it was only a few months ago where there was like really bad employment numbers came out, which typically would send the market down, but it actually sent the market up because people were like, oh, bad employment numbers means they're going to give us a rate cut. Like, it becomes so skewed.
So
it's like, we don't
4 chapters ahead.
I know. Everyone's like, it's like chess. Everyone's thinking way too far ahead. I don't know what was going on with that rate cut. It's the central banks probably shouldn't be getting involved in this stuff. It's more of a medical issue.
Yeah, absolutely. Yeah. So let's move on from coronavirus, because I think we're all kind of tiring of talking about it. The biggest news from the last week, apart from the virus, was the announcement that Disney CEO Bob Iger was stepping down. Iger has led the company since 2005, and it's fair to say he's been at the forefront of probably one of the most important periods in the company's history, leading the biggest transformations, including the acquisition of studios like Pixar, Marvel and Lucasfilms, the acquisition of pretty much most of 21st Century Fox, and the launch of the new streaming service Disney+. Why did Iger choose to step down now, Rory? It seems like a bit of an odd time, seeing as Disney Plus has just kind of been unleashed to the world.
We don't really know why he chose to. He had I think it was 14 months left on his current contract.
Yeah.
And it was a real shock. Like, no one saw it coming. They just assumed he'd see out the rest of his contract. But like, stepping down is like, he's not stepping down per se. He's moving into a more kind of creative chairman role earlier than he probably was going to anyway. Although now he says he definitely is leaving. He's just like absolutely leaving in 2021. I was reading over the history of Disney is probably one of the most, like, it's so filled with intrigue and scandal, and it's like one of the most interesting companies, I think. The history of it is just amazing. And there's probably no other company besides maybe Apple where who has been CEO it's been so evident that was their era. You know, this was
agree. That's
really,
right.
like, things change so massively based on who the CEO is. You know, like Walt died in 1966 and his brother took over for a couple of years, and then there was a couple of smaller family members who were running the business, and they went through like a really tough time in the 70s and early 80s where there was a total loss of kind of the creative soul of the business was gone. They were opening up all these theme parks badly that weren't working. It got so bad that in 1984, a guy called Saul Steinberg actually launched a hostile takeover bit of the business with the intent of breaking it up and selling it for parts. Which, I mean, can you imagine if Disney wasn't a company today? You know, it actually got to that point. He nearly was successful. He wasn't, and the Sid Bass family came in and saved the business and brought in a guy called Michael Eisner, who gets a very bad rap. You know, history has not looked kindly on Michael Eisner as a CEO, although, like, because of a number of high-profile blunders. But he brought along with him a guy called Jeffrey Katzenberg, and the two of them together did completely turn that business around. They focused heavily on the Touchstone label to produce more adult-oriented content. They had hits like Who Framed Roger Rabbit, which was one of my favourite movies when I was growing up. He got Disney into cruise lines, which is now one of their biggest businesses. And of course, he purchased ABC, which brought along with it a very talented young executive called Bob Iger, who, when Bob Iger first came, everyone thought he was going to quit because he didn't like Eisner. He hated being micromanaged. And Michael Ovitz, who was Eisner's kind of right-hand man, kept trying to kind of smooze him with expensive gifts, which Iger just absolutely hated. He didn't like that attitude at all. And everyone thought he was leaving, but actually Iger could see the company was in disarray and kind of very shrewdly positioned himself as the new heir apparent, or the alternative to an Eisner Disney. Yeah. And in 2006 got the job, and like, he totally changed the business again. Like, the business completely revamped and really focused hard on family entertainment. And, you know, obviously what you mentioned before, all those acquisitions he made, like building this huge IP juggernaut of anything family related is Disney. It's the instant thing you think of, you know. And this move now, you know, it felt like it was time for him to move on. He'd gotten them to this point. They're just about to launch Disney Plus in Europe. It's like, now it's time for another phase.
Yeah.
Now, who he brought in was odd.
Bob Chapek.
Yeah, Bob Chapek, a lot of people thought it was going to be a guy called Kevin Meyer, who had been Iger's kind of right-hand man over the years and had helped with all these acquisitions and was running the direct-to-consumer business. So if you think of Disney as their future is in direct-to-consumer streaming, if that's the new phase, you would assume he was going to be the CEO. I think everyone did assume he was going to be the CEO. But they brought in Bob Chapek, and I'm sure Iger had a part to play in that, and being the shrewd businessman wouldn't have picked someone he didn't think was going to be the person to run the business. Apparently he's pretty much the total opposite of Iger from everything I've read. He's not the happy, smiley, affable CEO. He's tough businessman. Don't expect to get a hug off him.
I heard the same.
But then he's been running their parks and resorts segment for years, and that is their biggest moneymaker. And it's one I often think is forgotten about. It's such an old world kind of part of their business, but how big their parks and resorts really are.
Yeah, it's huge. It's like I think it's their biggest revenue generator. And one of the great things we've talked about before about Disney Plus is that it's just a small part in a huge, much bigger organization. Netflix as a company, I love Netflix as a company, but they are relying 100% on people streaming and subscribing to their business.
Yeah.
Whereas Disney Plus is it's such a tiny little part, even at what they've got 30 million subscribers.
Yeah.
They don't need to make money off Disney Plus. That's only just getting Disney onto the TVs, getting kids looking at the characters, wanting to buy the merchandise, wanting to go on the cruises, wanting to go to the resorts, wanting to go to the cinema. Like, it's to them, Disney Plus is just a part of a much
it's another
bigger
entry point kind of into the ecosystem.
Absolutely, yeah, and that's why they're able to charge less, and why they're not. It doesn't have to be profitable for them. It might never be profitable for them if they don't want it to be.
It's an incredible story, and that was really well explained. You should write a book on Disney, that's for sure, Rory. But the share price in recent weeks has fallen from around $150 to around 120, and I from what I'm looking at, there's 3 data points informing that sell-off, which is of course the effect of coronavirus on the theme parks, the effect on the cruise liner business, and the change of CEO. And I actually believe that Disney today is as good a value, a giant business, as I've seen for years. That's when I look at even just normal metrics, it actually looks like an outstanding investment. I'm sure they have they must have on their books the value of all the real estate they own, literally land value of what they own. I mean, right now I think the market cap of Disney is like circa 200 billion. But when you look at the sum of all the parts, it just doesn't seem to me to be a business where 200 billion seems like a business that should be worth a lot more.
It's incredible when when you compare it to the big tech giants.
Yes,
how small
exactly.
it is compared to those.
It is, yeah, absolutely. I think Netflix is probably circa 160 billion market cap at the moment. I don't have numbers in front of me. Disney's around 200 billion. To think that they're in the same ballpark, to me, just doesn't make sense. Now, you can't do like-for-like comparisons with market cap. It's like comparing an elephant to a cruise liner. It's not a relevant comparison, but people like benchmarks.
Yeah.
And I just feel that Disney is a business that hasn't hit its true potential as an investment.
Yeah, it feels like there's an awful lot more to unlock in that business. And maybe they have been seen as one of those businesses that never had adopted to the kind of the new world of technology, and streaming's obviously their first real foray into that. Yeah.
A last point then. So there's 4 of us here. Luke on sound, our sound engineer. So who's subscribed for Disney Plus?
I haven't yet.
Luke has. I
have.
Luke
has.
A big Disney fan,
can you do it pre?
There's a discount. So it's €59 or €60, I think. And
speaking of Disney, terrible news.
What?
Baby Yoda dolls are gonna be postponed due to the coronavirus.
Oh, please, no.
It's sometimes
until when? It was bad enough with the new Bond movie being postponed.
Are you still long, Baby Yoda?
It's gonna hurt my. That's gonna hurt my my prediction thesis. This senseless virus.
The
true victims sometimes.
All right, moving on. So there's loads of great stuff to check out in my Wall Street app at the moment, including March's Stock of the Month report. Don't forget that there's also a brand new Stock of the Month podcast in the My Wall Street app too. This is a subscriber-only podcast where Rory and I chat about the one stock in the My Wall Street shortlist that we like most at the moment. March's Stock of the Month podcast will go live in the My Wall Street app next week, so make sure to go in and check it out then. Emma, you're going to do the company we never talked about today, and it is MercadoLibre.
It is indeed, James. So MercadoLibre is a stock, like so many, that I bought and owned moons and moons and years ago, and completely regret selling. Most especially now that it's up around 6-fold in value in the last 4 years. Let me rewind a little bit and say, so MercadoLibre literally means free market in Spanish. And MercadoLibre operates in 18 countries, but primarily in Brazil, Argentina and Mexico. And as we like to do around here, it's probably best visualized, although not entirely correct, as saying it's like the eBay of Latin America.
Yeah.
Or at least that's how it was once described. And if we just take a quick look at what MercadoLibre looks like today, just before we kind of go a little deeper, it's a $31 billion business. And as I said, 4 years ago it was about $100 a share, so it's up about 6-fold. It's about $642 a share at the moment. And it's a business that when you look through the numbers, as anyone can freely do on Yahoo Finance or equally, you find a lot of very nice numbers about the business. For example, insider ownership, something we value. around here is nearly 12%. And to find a business that's worth $31 billion, of which 1/8 is owned by insiders, which is generally defined as senior executives, founders, and key members of staff, to have 1/8 of a $31 billion business owned by the insiders is a very strong sign. Because everyone inside really wants the business value to be reflected in the share price.
They've skin in the game. Yeah.
They've skin in the game. I mean, it has a load of cash on the balance sheet. It's about $2.5 billion cash. So when you look through the numbers of MercadoLibre, you really do see a lot of things to admire, and it looks like a great business. I guess when I think of MercadoLibre and having bought shares, I can't even recall when, but it must have been 15 years ago. It was tantamount to an investment in Latin America. This was a way of exposing your portfolio to the digital growth in Latin America.
So geographic diversification.
And truly geographical diversification. Like, as I say, it's covering 18 countries. And you're getting in to a business that has operations that it's kind of gone far beyond being the eBay of Latin America now. It has 5 main business units. They have a marketplace, which is its platform for users to sell products. They have their Mercado Pago, which is the payment platform for online sales. It's the Mercado Publicado, is the advertising portion of their business. There's Mercado Shops, which is a tool designed to enhance the platform's overall ecosystem. And then there's the Mercado Credito, which is the company's credit line. So it has 5 business units. And to say, as was once described, that it is the eBay of Latin America, really does undersell it. It's too reductive.
You can see
entirely.
Of like Shopify and Square and other
this is
businesses there too.
Yeah, you're right. You could as easily say it's the Square of Latin America, although we prefer to reserve that idiom or turn of phrase for Stoneco. But it is, you could call it as you say, the Shopify. Thank you. Shopify of Latin America. You could call it the Stripe of Latin America. So it is a business that is truly admirable from a numbers perspective. So what really matters to us is that's great. It's now a $31 billion business. It's $642 per share. But is it a good investment today? And the consensus view, which frankly has never made anyone rich, if you ask me, is that it's a little overvalued. But I happen to disagree with that. I still think that MercadoLibre is the best investment that I've seen for exposure to 18 countries in Latin America. It offers so many solutions for so many business owners in so many countries that I think that its future is just as bright today as it was 5, 10 or 15 years ago. It's in a much stronger position. It's a known brand. And the business itself, and I looked at the last quarter's reports, its net margins its net revenues are growing faster than its gross billings as a percentage, which really means the business is getting a little more efficient. But equally, you can see costs creeping up on 2 particular line items, which is this shipping and distribution. It seems that they pay for the shipping of products bought on their platforms, and they've spent quite a lot on marketing, which is a long play. And marketing really is just compounding your brand into the minds of buyers. So I can't actually find a reason to dislike MercadoLibre, even the fact now they've gone into a strategic partnership with businesses that were once regarded as rivals, and that is specifically PayPal and divisions of PayPal's business like Zoom. So they are a business that have very strong strategic partnerships with the companies that otherwise you would think are their biggest rivals. And eBay, for example, was once a shareholder in MercadoLibre, and as far as I recall, dumped the shares, but with the greatest of friendship. It's almost as if they sold the share and then decided to make each other even stronger. And the history of MercadoLibre has a bit like Disney. It's not as interesting as Disney, but it has so many different verses and chapters and like aspects to the business. It is really, I think, an awesome way to get exposure to the giant market that is Latin America.
Absolutely. Rory, are you a fan of MercadoLibre?
Yeah, I really like MercadoLibre. I mean, one of the, not to harp on, because I think you cover quite a lot there, but like, I always think with MercadoLibre, you know, if you think about how they've performed over the last 10 years in what has been, you know, at times very hostile environments, imagine what they're going to do when times are good, you know?
Yeah, that's right. Yeah.
That was always one of the criticisms, like, oh God, you wouldn't invest in Latin America. Think of all like the corruption down there and the political instability. It's like, well, look at how well they've done during all this, you know?
Yeah, it's true. And they're incorporated in the US. They're run from the United States. And as far as I recall, they were founded by someone who was in Stanford University at the time. And so it's a business that understands Latin America and the many countries within and is run to US standards, which I happen to believe are the best.
It's been a big winner for us too, up about 130% since we picked it 3 years ago.
Yeah.
So that is MercadoLibre, the company we never talk about. Let's move on to Jargon Busters. And Emmett, I'm going to keep you talking and throw the first question towards you. One of our users asked, is iRobot a technology company?
I thought that was a great question.
Yeah.
Because my kind of gut reaction was, yeah, of course it is.
Yeah.
And the formal definition of a tech company, and I read here, is a technology company is a type of business that entirely focuses its development on the manufacturing of technology products or providing technology as a service.
Yeah.
But that's a very simple strapline. You know, like, the question is iRobot a tech company? You can take that question and go, is Apple a tech company? And you can have an experience with Apple, rare as it might be, where you walk into their shop or their store and the only thing you buy is an iPhone cover.
Yeah.
You've bought a piece of plastic and the only product you've bought from Apple is a piece of plastic. So is it to you a tech company?
Yeah.
I know it sounds... So to go deeper on whether iRobot is a tech...
Well, just on that point,
Yeah.
like recently, I think the most famous example of someone claiming themselves a tech company was WeWork.
Yes, entirely.
Which definitely weren't a tech company.
No. And in fact, so it was a blog, Stratechery, that Rory, or maybe you, James, switched me on to Ben Thompson's blog, which is absolutely wonderful piece of writing. He actually asks the question, what is a tech company? And if so, is Peloton and WeWork a tech company?
Yeah.
And that was very interesting because Peloton and iRobot, you can really see how similar they are structurally. You have to take delivery of a piece of hardware. It's connected to the internet, and it exists in your home. So you can just see the parallels. This blog post by Ben Thompson is well worth a read to go deep on whether a company truly is a tech company. And he says there's 5 evaluation points. That a tech company does 5 things. It creates an ecosystem, like a social network.
Yeah.
It has 0 marginal costs, so it doesn't have to ship hardware, I guess. It improves over time. It offers infinite leverage, so it can kind of serve the whole world, and it has 0 transaction costs.
Okay.
So those 5 bullet points, if we superimpose those onto Netflix and ask, is Netflix a tech company? So the first one, it creates an ecosystem. So with Netflix, there's no real software created ecosystem. They create content which they distribute. So that's kind of a red light on the traffic lights. Netflix shows are delivered at 0 marginal cost without the need to pay distributors. Though there's kind of bandwidth costs. So yes, there's a tick on the 0 marginal cost. Their products improve over time, so that's a green traffic light. So we've red, green. Netflix is able to serve the entire world because of its software. It gives them more leverage over their competition, and then finally it can transact with anyone over their self-serve model. So therefore, when you run Ben Thompson's measurement over Netflix, you can conclude that, it's a tech company.
Yeah.
So bringing that to Peloton, and we're going to get to iRobot.
Yeah.
So Peloton is the one that Ben Thompson takes a look at. And he says, while it's available as an app, the full experience requires a 4-figure investment in a bike. Yeah. And that, needs to say, is not a 0 marginal cost offering. Its product does improve over time. The size, weight and installation of a Peloton bike, it means that the distribution is hard going. I mean, principally they sell in the US, UK, Germany, so it's not switch it on everywhere.
Yeah.
And it has a high touch installation process. So he said it's pretty iffy, Peloton, as these 5 factors go, as to whether Peloton is in fact a technology company. Which brings me on to iRobot. And if we apply those 5 lenses that Ben Thompson defined to iRobot, does it create an ecosystem as like a social network? No, it does not. Has it zero marginal cost? In other words, no hardware? No, it does not. Does it improve over time? Yes. It fully learns about the new iRobots learn to shape your home.
Yeah.
When I look at the map of my home on my iPhone and the iRobot's done a run around my house, I can see things that might have been left on the floor that it's actually walked around. And it is sharing Wi-Fi mapping with Google. So yes, it does improve over time as far as I'm concerned. Does it offer infinite leverage? Can it serve the whole world? Well, an iRobot is lighter than a Peloton and it's easier to ship, and I got one delivered to my home the day after buying it. So I think why not infinite leverage? Its leverage is easier it's more widespread than a Peloton. And does it have zero transactional costs? No, it doesn't. You have to ship hardware. So is iRobot a tech company? I think so. More so than like Samsung's home appliance business. So you could say, is Samsung Fridge a tech company?
Yeah.
And the thing about the real question, is iRobot a tech company, is almost tantamount to love. It's hard to define. You either know it, it when you see it or feel it. So like, I look at my iRobot, I see it walking around the floor. I'm sure in 20 years people will laugh at how primitive it was. But right now, I get a kick out of its high-techness. Yeah. So as far as I'm concerned, it's a tech company, but if you run it through the absolute,
the rigid lenses,
it might just be a hardware company with some decent software.
Okay, interesting. Thanks for that, Emmett. So the next question we got here came via the MyWallSt app, and this customer asked, with the US opening sports gambling laws, are there any companies you guys are keeping an eye on in relation to this? Rory, I know you wrote a daily insight in MyWallSt about this earlier this week.
Yeah, so it's not legal in the United States yet. It is in certain states. The Supreme Court, I think in May 2018, struck down a previous bill that had made it illegal federally, but obviously every state now has to come in and decide how they're going to legislate it on their home turf. And obviously every state has different things that they want to do, and some of them are actually kind of really odd, as I discussed in the Daily Insight. Like Mississippi will allow you to gamble on your mobile device, but only if you're standing inside a casino. Which doesn't make a lot of sense. Yeah. Rhode Island has this really bizarre, like if you want to get a gaming license in Rhode Island, you have to answer this ream of questions, which includes, did you ever own a gun, and do you get on with your mother-in-law?
It's a very telling question.
You're joking, I'm presuming.
No, this is totally true. I read this on the Financial Times.
So seemingly then nobody has a...
So I mean, like, the thing is, like, why... it's so. First of all, gambling's been going on. Sports gambling's been going on in the US for forever. And it's my personal view has always been, why would you make something illegal if it's already happening? Like, you're just putting you're just turning a blind eye to what's already happening. It's better to regulate things, better to get them better to have some control over things. Yeah. So I think this is a positive move, even though, as we've seen in the UK, where sports betting has been around for a long, long time, it has quite severe social impacts. And, there's research to suggest in the UK alone, 500,000 problem gamblers have had their lives damaged by debt, depression, family breakdown, or in the worst cases, suicide.
Okay.
So it's interesting that, like, what is a mature market in the UK is seeing all these problems, and it's just opening up in the US. So you wonder, like, are they going to learn any lessons from their neighbours across the pond? And
you would really hope so, yeah.
You would really hope so. But then at the same time, there's an awful lot of money in this. This is being described as America's next gold rush.
Okay.
The Gambling Compliance, which is an industry research firm, values the market at up to $8.1 billion by 2024. But, and this is a big but, the American Gaming Association believes that there's $150 billion in illegal sports betting in the US every year. So there's a very wide gap there in terms of really no one knows at the moment. And this is all, like, there's a lot of things that have kind of come into this now so that it's being legalized. It's slowly being legalized pretty much across the country. I think there's 20 states who have it legal now in some form or another, and it's estimated that it'll pretty much be in nearly every state in a couple of years. But we can't really yet see who the companies are that are going to profit off it, because it's so diffused at the moment. You know, like, and strangely enough, the companies that I have been looking at carefully are mostly UK-based companies. So the old term bookmakers, the old style bookmakers who've been around in the UK for years, are getting in there really quickly, and they're doing deals with the major casinos and getting sports books set up very, very quickly. GVC is one. They are the owners of Ladbrokes Corral. William Hill are another one. There's a company 888. They're all doing deals with American casinos, and the one that actually is really interesting to me is a company called Flutter Entertainment, which Irish people will know as the owners of Paddy Power, our national bookmaker, if you will, almost. It's almost like a state enterprise. You know? Flutter bought, the same month that Supreme Court decision came out, Flutter bought a company called FanDuel, which we talked about a couple of years ago, which was one of these fantasy sports betting companies that had done very well before kind of the New York state attorneys started going, hold on a second, this looks very like gambling. And there was a little bit of a to and fro there, but they are legally operating now. So they would be the company at the moment that I would look at and think they probably have one of the best chances, Flutter Entertainment. And unfortunately they're not listed in the US. But if this is as big a gold rush as we think it's going to be, I'm sure that's going to change.
So coincidentally, James, yesterday I spoke at a Flutter Entertainment get together for staff, and really my angle was, what's the difference in investing in gambling? But it's you're right, it's actually a very impressive business, and it's a pity it's not listed in the US. Here's a question, and I'm not very well read on the subject. Is there peer-to-peer gambling platforms so that we can, basically, it's a marketplace for gambling?
Oh yeah, Betfair. So Flutter Entertainment own a company called Betfair.
Oh, so Betfair, that's what they do.
Peer-to-peer, yeah.
I was unaware of that. Shows you how little I know about gambling.
Yeah. Cool. So let's move on then to the elevator pitch. So this week's elevator pitch also comes from a customer question. Stephen emailed us at pod@mywallst.com asking if there were any private companies that Emmett and Rory are following in the hopes they'll go public in a few years. Rory, I'll come to you first. Any private company you're hoping will go public?
Yeah, there's a company that is based literally just around the corner, founded by two brothers, from everything I've read and heard, two lovely lads called the Causation brothers, and it's called Stripe, and it's a payments company. I like payments companies, and Stripe is kind of one of the big private payments companies that unfortunately we can't invest in. I just really like that business. Everything I read about them, they seem to be very positive people out there to empower entrepreneurs as best they can. They launched a service a couple of years ago called Stripe Atlas, which essentially let any company in the world incorporate as a US company for something like $500, which is like really amazing, just from a good guy perspective, letting companies in the harshest parts of the world become American incorporated and get access to banking and funding and stuff like that. Absolutely. They seem to have a really good company culture, and I like them a lot. And unfortunately, I just saw their last valuation has them at like $35 billion.
Same as Airbnb, so $35 billion.
They don't seem to have any reason to go public. Why would they put themselves through that?
We are customers of Stripe here, aren't we?
We are, for our non-app products are generally powered by Stripe.
Yeah, cool. Great company.
It is a great company, actually. Yeah, likewise. I prefer your answer, Rory. Let me start with that, so we don't need to vote.
We'll end it there.
We'll end it there. I guess the one that I'm at least very interested in, it was off the back of a Fortune article a while ago of the mega growth of TikTok, which is a Chinese video sharing social network owned by ByteDance, and it's for anyone who is exposed to anyone under the age of 15. I can imagine that they are fully aware of TikTok's influence on the average home and the mind space occupancy that they have in a young generation, and how they monetize it remains to be, I suppose, completely seen because it's still a private Chinese company. But when you have completely dominated the process of somebody in their youth, you have a great position to sell them things when they're older. And it's a business that I just think it kind of creates short lip sync comedy and talent videos, and it's a bit of fun, but its usage is off the scale. And I'm afraid I don't have the numbers at hand, but its growth, I think it's the fastest growing platform in the history of the world. It just overtook, everyone's benchmark was the uptake of Facebook and all the other social platforms, but TikTok just exploded. It was just there. It was like the most instant thing you could ever imagine. And that, therefore, I'm interested to watch the business, see if they float.
Yeah, you certainly have to give them credit for, you could look at social media and go, well, like there's no room left. Facebook owns everything.
True.
They were like, no, we're going to take them on.
Yeah,
and they
exactly.
successfully have. So
it's incredible.
Well done to them.
Yeah, indeed.
Very down with the kids, Emmett.
Yeah, exactly.
So that's about it from this week's Stock Club. Don't forget about all the great new stuff in the MyWallSt app at the moment, especially the Stock of the Month podcast. Make sure to go in and give that a listen. If there's anything you want us to discuss or explain on the next episode of Stock Club, make sure to get in touch with us on Twitter. That's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club too, and if you're enjoying it, please leave us a review on whatever podcasting platform you listen to us on. From all of us here, we'll talk to you in 2 weeks. Happy investing.